What's up? Welcome to the Confluence.VC podcast. This podcast is meant to give you a personal glimpse into the next era of investors and operators. All right, this week we had on Melissa Widner with Lighter Capital. So Lighter Capital is a revenues-based financing fund that helps SaaS businesses raise capital without giving up ownership. We're going to dive into a lot of that in this episode. But Melissa's background, she's a former operator, ran a previous venture fund before being a CEO at Lighter. She also sits on a bunch of different boards, probably one of the smartest people we've had on. In this talk, we discuss revenue-based financing dynamics, ownership preferences of founders, and how downturns affect capital markets. All right, cool. So Melissa, first off, really appreciate you coming on. I know your time is valuable, so we can jump right into it. We like to start these talks just by learning a little bit more about you and your background. So can you give us the elevator pitch on your quick story, who you are, how you got to where you are today, and what you're working on at Lighter?
Yeah. Well, thanks, Clay, for having me here. I was, first and foremost an entrepreneur. I was one of those people that had, a company or a little business when I was like 10 years old. So I was always an entrepreneur. I started a couple companies and ran a couple companies that had really successful exits. One was a low-tech manufacturing company, and one was a software company in Silicon Valley called Seven Software that was acquired by Concur Technologies. I then became an angel investor and went into venture capital, and I spent the better part of 2 decades in venture capital. Most recently, I was running National Australia Bank's venture fund. And through that, I made an investment, or National Australia Bank made an investment into Lighter Capital. And Lighter Capital is where I am now. I went from board member to CEO in 2020. And Lighter Capital is the pioneer and the leader in revenue-based financing for SaaS companies. So Lighter Capital started in 2010 and has provided close to 500 companies now with non-dilutive financing and close to 1,000 financing rounds.
Yeah, it's awesome. That was going to be the follow-up question I had. So let's talk a little bit more about Lighter. Have a pretty good understanding just on like elevator pitch on you all, but what exactly do you guys look for when you're looking at companies that kind of match the thesis for revenue-based financing? Like, is there a typical profile of what that looks like, or like how do you guys evaluate what's a good fit?
Well, we're looking for recurring revenue, which it doesn't have to be contracted recurring revenue, but we're looking for the ability for us to predict revenue, because our typical loan is about 3 years. And so we're looking at the revenue the company will generate in those 3 years. And they're paying us a percentage of the revenue. It's usually a small percentage, under 10%, until their loan is paid back. So if they grow faster, they end up paying it back faster. But we look for companies that have been in business for at least a year, have had revenue for at least 6 months, and have at least 15,000 in MRR, in monthly recurring revenue.
Nice. Is that primarily US and Australian based companies, or is there like
US, Australia, and Canada? Yeah, we've been operating in the US since 2010, and we just launched in Australia at the end of or beginning of 2021.
Nice. All makes sense. So at a high level, for those that don't have a ton of experience, just looking or evaluating revenue-based financing options, could you explain how that works and how you guys are positioned to help companies out?
Yeah, well, it's a really simple process. Our application takes under 10 minutes to complete if you're a slow typer. We basically take information from your banking and your accounting data to see how much you would qualify for. And then if it looks like you would qualify, we would issue a term sheet. That can take as little as like a day or two from the time the application is submitted. And, you can have funding in a matter of days. And the funding is typically a multiple, or companies will qualify for a multiple of their MRR. And for smaller companies, that's typically 4 times their MRR. And for larger companies, it's 6 times their MRR. So it's a great alternative for companies that don't want to go down the venture route right at that very time for whatever reason. And there could be a lot of reasons. Like a lot of our companies just, they're not going to qualify for venture. They're really great companies, good growth companies. But as you know, given the space you're in, venture capitalists are unicorn hunters. And there's a lot of great companies that aren't ever going to, that their TAM just isn't big enough to attract venture capitalists, but they still need growth funding. There's another subset of our companies that just don't want to give up control. Or they're not ready to give up control now. So they don't want to bring anyone else onto their cap table. They don't want to bring on a venture capitalist that maybe doesn't know, much about their business and give up any control there. And then we have a lot of companies, especially now in this market, that use us to fund in between rounds. So if they don't want to price around, so we come in and we just give a fixed amount of money and the company pays us back a fixed amount of money. And there's no, we don't price the round at all. It's a fixed amount that we provide and a fixed amount that the company pays back. So it's a lot less expensive option for growth companies than equity, because you're not giving away any of your company.
Yeah. Especially over the last few years, has that been the major reason you think that companies come to you, is like they have more focus on equity ownership? I'm just curious, like why, like the reason behind like a lot of the companies that come inbound, is it primarily the ownership piece?
Well, because we've done so many of these financings, we sort of have a lot of different reasons. But I can give specific examples. So in fact, I was just meeting with one of our companies called Red Route. Great guys, 3 guys that started their business out of Cornell. It's really a CRM add-on tool that's simplifying what they do. But they came to us when they had $1.5 million in revenue. They, I think, had raised some angel money. And then they took 2 rounds of funding from us and grew their company to $3 million in revenue. We actually helped them. They were ready then to do a VC round. We helped them with their pitch deck and made introductions. And then they ended up getting funded by one of the VCs that we introduced them to. But they were able to get to, if you think about, a company's valuation is a multiple of their ARR. So when they came to us, they had $1.5 million in revenue. And let's just say it's 10 times ARR. I know it's really different today. It was higher a year ago than it is today, but let's just say 10 times ARR. So let's say they were worth 15 million. Then they took 2 rounds of financing from us, about 800,000, and they grew their company to 3 million in ARR. So they basically, if you take a 10x ARR, they grew their valuation by $15 million. So it was a really inexpensive way to grow their valuation by $15 million. Because they didn't give any equity away. So when they went out to raise from VCs, they were really in a much better place. So that's one example. And then we have other examples. A couple of our former customers took all their rounds of financing from us and then sold their company. And so when they sold their company, they and their employees owned 100% of it. They never had to give away any equity.
Yeah, no, it's interesting. Out of curiosity, who are the main players in the like debt-based financing that you compete against? Like in my head, I'm thinking Pipe and like maybe Strike Capital, like traditional SBA lenders. Is that kind of spot on? Are there others that I'm missing? Or you guys, I know your position slightly different than all of them, but are those kind of like the main other players that you compete against?
Yeah, those tend to be pretty short term. And it's a fixed amount you're paying back. Actually, with Stripe, they're plugged into your billing system or your payment system, and they're just collecting, I think, on a daily basis, a percentage of the payments, and those tend to be very short-term loans. With Pipe, it tends to be like a year or less, and it's a fixed amount you're paying because it's a contract amount. And we actually have that product too. We have contract financing for companies that want a shorter loan. It's usually more expensive, but it's if you need less money for a shorter period of time, it works.
Got it. No, it makes sense. How are you all dealing with the market correction? Like obviously things like more on the venture side, like venture funding, everybody's talking about how that's slowing down, probably going to continue to be pretty slow over the next few months as people try to figure out what's going on. How are you all dealing with that? And do you think a slowdown in venture actually better positions Lighter?
Yes, I think it does. So if you think about Lighter, I started my venture career in like 2000 and went through the dot-com crash and then the GFC. But if you think about when Lighter started in 2010, we've pretty much been in a bull market since 2009 until recently. So when venture capital is easy to come by, and when you kind of know, like if you make progress with your company, you can raise more at an up round. And that's what, it's all about, is putting, getting to the next round and the higher valuation. So if you look at what's going on today, and I mean, I know, Clay, you're familiar with all these numbers, but in terms of public SaaS companies, the average multiple now is about, I think, 5.5, where, and if you go back in the last year or two, it was up to 10 and 12, and that's average multiple of ARR. And you take the top, the fastest growing companies. I think I was reading the fastest 25 fastest growing public companies were trading on a 52 times forward ARR. And now they're trading at 8. So what that means is, let's say you raised money a year ago and you raised it, I don't know, 10, 20, or 30x ARR. And then you did well, and you actually are one of those rare companies that hit the plan. If you're going to go out and raise today, you're probably going into a flat round at best and potentially a down round, just because those valuations, VCs are looking at a multiple of ARR. So nobody wants a down round. The entrepreneur doesn't want it. It's not great for employees to say, to have to explain why, your options are potentially underwater. VCs don't like it, because then they have to do a write down on their portfolio. It makes it harder for them to raise their subsequent funds. So I think this is a great time for a product like ours, even for VC-backed companies, for in-between rounds. So if you need growth capital now and you don't want to spend a lot of time fundraising, and you don't want to price around or give away equity, I think that a market like this will be really good for us.
Yeah, I totally agree. I mean, I've had a lot of conversations with friends that are working in startups or like running their own startup. It's venture backed, and it seems like they're all having these conversations. Like they either cut a bunch of people, or they like run out of business to the milestones, and like nobody really wants to cut. No, obviously nobody wants to run out of business, and nobody wants a down round. So if you want to maintain growth and hire and headcount, like product like yours is perfect for them. So yeah, I mean, now I'm just going to start referring stuff your way. Like anytime I hear.
Thank you. Yeah. Well, I mean, the reason, so I told you I was an operator before I went into venture, and it's way harder being an operator. It's much harder. I think it's also much more rewarding, but the nice thing about going into this role is, we're working with, it has a similarity to venture in that we're helping entrepreneurs and we're helping them with funding. But one of the reasons I jumped back into an operating role is I just had never been involved in a company whose customers, love them as much as Lighter Capital customers love Lighter Capital. And I think it's because, Lighter comes in, they provide them funding. A lot of times these companies have been, banging their heads against the wall trying to raise equity funding, and haven't had luck, or have gotten some terrible terms, so we provide them with funding. It's super simple. And then we just help them. We don't take a board seat. We don't take any control. We just give them money and help them. So I think that this product it works in all markets, but I think especially in this market.
Yeah, I couldn't agree more. You want to jump to quickfire questions?
Yeah. Let me just getting a little bit of distraction here. Okay, there. Sorry, kids.
All good. So we have these 4 questions at the end meant to be answered in 2 sentences or less. First one we have is, what is a recommendation you hear regularly that you think is bad advice?
Oh, yes. So, get the highest valuation. Go for the highest valuation.
Yeah.
You should get the best investor when
Yeah.
you're looking. The valuation that matters is the one at the end.
100% agree. In the last year, what new belief, behavior, habit has most improved your life?
What new belief or habit? I would say what I would like it to be is exercise and make that more regular. It's become more regular, but I'd like it to become even more regular.
Nice.
And maybe in the last couple of years, the new belief or habit has just been, don't sweat the small stuff. Like most of what we do on the grand scheme of, in the grand scheme of life is really minor. And the things that we stress about is really minor. So I think in the last 2 years, I just stress a lot less than I did, when I was a younger CEO.
Yeah. It's not going to matter in 5 years.
Yeah. I mean, if you've got your health and your family's doing well, why are you stressing about the little things that you can't necessarily control?
Yeah. 100%.
So I've gotten a lot better about that. I wish I had been better about that in my 20s when I was running my first company.
Yeah. What is one piece of advice you'd give to somebody starting a company today?
Well, a lot of advice I give is to people who are thinking about starting a company, and that is to do it and not be afraid of failure. Everybody's afraid of failure, and failure sucks. But the biggest regret you're going to have is if you don't try something versus trying something and failing. So that's sort of the pre. If people are thinking about it and they've been thinking about it a lot, I always encourage people to do that. And then, just make sure when you're bringing on investors, you're bringing on people who share your vision and want to support your vision and want to support you to reach that vision. It sounds simple. And it also, there's a big assumption in there that, when people say choose your VCs, there's this assumption that an entrepreneur is sitting there with like 10 term sheets and picking which one to choose, when the reality is they're lucky to get any term sheet. VCs only fund 1 out of every 100 companies that they meet with. So it's great advice to give, to say choose your investors wisely, but the vast majority of companies have very little choice.
Yeah, couldn't agree more. And then last question we got is, if you had one ask for our listeners or audience as a whole, what would that ask be?
Well, the ask would be, if you're raising money, just check out our option. It's a great one. I mean, it doesn't work for companies that need to raise millions of dollars and have just a little bit of revenue, because we can fund a multiple of your monthly revenue. But if it's, if you need that growth capital to get to the next stage, it's a really good option.
Yeah. And the VCs that you currently work with, just for like a lot of them having their own portfolio companies that need to partner with you guys instead of raise a down round, is there like a criteria or like a type of fund that you all do most of your business with on that side?
Because most of our businesses are B2B SaaS, we tend to work with a lot of companies there, but it's really any company. We don't do a lot with life sciences VCs, because typically those companies go a long time before they have any revenue, so they wouldn't necessarily fit our model. But we also have direct to consumer companies. VCs are a great referral source for us. Like I said, I was a VC for a long time, and VC, the worst part about being a VC is that you're just constantly disappointing people, because you're saying no 99 times for every one time you say yes. So I always, when I said no, which was most of the time, I wanted to give the entrepreneur something, because you're saying no to like the most fascinating people on the planet, and the most interesting people on the planet. So I was always trying to figure out, where could I point them, what direction could I point them, where they could maybe, could be helpful for their company. So we get a lot of referrals from VCs who turn down companies that aren't quite ready for them yet. And then on the flip side, when our companies are ready to raise money from VC, we're able to provide warm introduction.
Yeah, absolutely. Well, yeah, again, I'm just going to start shooting referrals over you guys. Again,
Thanks, Clay. And me too. I'm like, I think we should have a goal of getting every Australian VC to sign up for your service. I like when we were talking before we started recording. I mean, I wish this had been around when I started my VC career. There was nothing like this.
Yeah.
And I mean, what a deal. $400 a year. That's like a no-brainer.
Yeah.
Everybody should sign up for that.
Yeah. Yeah. We need more social proof like that. Well, yeah, I mean, that was kind of the genesis of why we started it. I mean, Tyler and I both started our careers in venture, had literally no onboarding playbook, was just told to figure it out on our own. And we did that, but it was very steep. So the goal is just make it a little bit less steep for next generation of people. So yeah, that was our thought process.
It's so good.
Yeah. Well, cool. That's all the questions I had. I know you're super busy, so I don't want to take up too much of your time, but Melissa, thank you so much for coming on. This has been awesome.
Well, thank you. Have a great rest of your day.
Yeah, you too. Awesome to meet you. Huge thanks again to Melissa for coming on. We hope that each of you were able to pick up something valuable from this talk. If you're looking to get in touch with Melissa, I've linked her social info in the description below. And you can also check out Lighter if you're a company that matches all the criteria we were walking through in that talk. You can check out their website at lightercapital.com. For next steps, if each of you have not submitted your info to become a member yet, you can do that through our website at www.Confluence.VC. And also, if you want to become a subscriber to the newsletter, we offer a ton of free resources in there each and every week meant to help you become better at your individual roles. You can subscribe there at www.confluence.substack.com. Hope that helps. Hope to hear from y'all soon.